So you've seen the gold price in the dollar, but have you looked at it in other currencies? And what about gold price ratios? I'm talking equities, I'm talking oil, I'm talking housing, I'm even talking wheat. These top ratios tell us so much about gold's performance, not only in the last year, but more importantly for the year ahead. And that's what we've got coming up. Gold and silver prices have been rising since early November after setting a high for the year in early March, soon after Russia invaded Ukraine. Gold was on a declining trend in US dollar terms until early November. Now, in other currencies, gold has fared better and trended sideways since May. For the majority of the year, gold and silver prices face stiff headwinds of tightening monetary policy, rapidly rising interest rates, and a surging US dollar. But with expectations that central banks are set to slow the pace of increases and the resultant rollover in the US dollar, gold and silver prices have started to climb again. Other asset classes have also turned upward, notably US equity markets. The change in momentum is a good time to provide an update of gold price correlation to other asset classes. Now, as a reminder, the long-term correlation of the gold price to equity markets is zero, which means that there is not a clear relationship between gold and the S&P 500. So in other words, there is not a general rule that shows if the S&P 500 increases in a 12-month span, then gold is likely to increase or decrease. In shorter timeframes, the historical experience is different. Now, in certain specific short timeframes, such as at the beginning of a recession, gold prices and the S&P 500 index both decrease. And in times of significant war or geopolitical events, the gold price generally rises and the S&P 500 declines. Now, having said all that, we can see from this chart a cyclical pattern to gold and the S&P 500 as a ratio. The peaks in the ratio shown in the chart signal a peak in the gold price, and the trough, or the bottom, of this ratio between 99 and 2000 signaled a cyclical peak in the S&P 500. The ratio appears to have formed a bottom in December 21 when the S&P 500 set its new high and has been increasing since. Now, this indicates that a new high for gold could be on the horizon. Similarly, the gold price ratio to the broader MSCI World Equity Index shows a very similar pattern as the ratio between the gold price and the S&P 500. However, taking a look at gold price in sterling to the UK's FTSE 100 shows a different pattern. Since 2013, the ratio has been moving higher. Two key reasons are that the FTSE had a less of a run up from 2020 to the end of 21, and gold has performed better in sterling than the US dollar. Now, turning to the gold price ratio to two key commodities, wheat and oil, and we can see from the upcoming charts that the ratio has returned to average. The ratio of the gold price to wheat is stable and trading within a rising band, and the ratio climbing from 2010 through 2020. However, the higher prices of wheat due to the supply shortage has this ratio back at the longer term average. The gold price to oil ratio shows that neither commodity has had the upper hand for long. There is not a clear cyclical pattern to the ratio, which makes sense, as each has an important role that the other cannot fill. The spikes in oil price are generally oil supply specific. Now, the last ratio is the gold price, again in sterling, to the UK house price index. House prices have been a good store of value. However, the relationship continues to be surprisingly similar to the gold price ratio with the S&P 500 and the MSCI indices. Why should the gold to housing relationship have more in common with gold to stocks than with gold to oil? Our answer is leverage. As we see, the stocks and housing are far easier to take with borrowed money or newly printed money than is, say, a barrel of oil. Said another way, stocks and housing are connected by virtue of how they both benefit from low interest rates and both can perform less well in rising interest rate environments. Gold, like oil, is far more outside the financial leverage system, which has overrun all of us since 1971. And our conclusion from all this? Stay away from other people's leverage, since it could drag your own investments down. Gold and silver are a great way to insulate yourself from risky bets made by other people.